Hello, I'm James Kirby, the Wealth Editor at The Australian, and welcome to the Australian's Money Puzzle Podcast. Welcome aboard, everybody. This week I've got someone I talk to all the time. I haven't had him on the show before. I should have. He's one of the most strident voices, actually, in the property market. Independent analyst, runs his own operation. It's called SQM Research, and it's Louis Christoper. How are you, Louis? How are you?
G'day there, James. Thank you for the kind words. Nice to be with you and your audience.
It's great to have you on. As I've just said, we have talked regularly for years and years, and we should have done this ages ago. Anyway, really good to have you on. You just brought out you just issued. How this report you just sent me? Is that a monthly, or what's the rhythm of that publication?
It's our monthly measure of total residential property listings in the Australian housing market.
Okay.
And the value of it, as we see it, is that it gives a very good indication in terms of whether housing supply of established homes is increasing or decreasing. And if it's increasing, that may create a bit of a softer market if it gets to certain levels, and if it's decreasing, most likely that means there's more buyers and sellers out there.
Okay, and what's the key takeaway on that front from the report? I know there's a few layers to this report, but what's the key takeaway for you?
The key takeaway was that for the month of February, there was an absolute surge in new listings in the marketplace. So typically every January and especially February of each new year, you see the housing market seasonally open up. Agents come back from their holidays, so do sellers, and they list their property. So you normally get a surge in February. But what was more striking this time round was the year-on-year comparison. So, for example, Sydney new listings compared to this time last year were up by 22.5%. Melbourne new listings were up by 20.3%. Brisbane's listings were up by 8.2%. So this is a stronger start in terms of supply and activity in the market compared to this time last year.
Okay. Why?
Why? Very good question. And we might say too with this, and it is the case of our more conservative auction clearance rates, that the auction market has opened up very strongly. Clearance rates are up as well.
Yes.
And so for whatever reason, there is an increased level of activity in the marketplace from both buyers and sellers. So it seems as though, to me, sellers are keen. They think prices are good and they wish to sell. And buyers are very active, more active than actually this time last year in our capital cities. They're keen to buy. So on both sides right now, people think it's a good time to transact.
Okay, so a pretty healthy, balanced, but buoyant market, which should be useful for all concerned. What about investors in those numbers? Is that tracking more or less in parallel?
Through these numbers, we're not sure the exact levels of investor activity. However, what we do know is from the Australian Bureau of Statistics with their housing finance approval numbers that investor activity actually has increased over the last 3 to 4 months. So investors, according to our national state analyst, statistician, are telling us that investors are definitely more active in the housing market.
Okay, right. And one of the things I saw you of late is that you were pretty dismissive. There were some reports, I can't remember where, for all I know they were in News Corporation somewhere, but there was talk of softness in clearance rates, and you've been pretty dismissive of that. Looking at those numbers, I see why.
Yes, that's right. So I think we all need to be very careful about relying too much on these preliminary auction clearance rates that normally come out on a Saturday evening. Unfortunately, they're too timely, James. They don't capture the whole auction market. We report ours on Tuesday, which captures the whole auction market. And the clearance rates didn't really soften at all, as what was widely reported in the last week of February. They actually held reasonably firm So it's definitely been a stronger start to the year, stronger than what we actually expected. Our anticipation was that Sydney and Melbourne would record some modest to moderate housing price falls in 2024. And
That's
I've
I
got to say, if
remember.
the market
Look,
continues
yeah,
to rise, if the
yeah.
market continues to be this active, we'll be wrong on our forecasts.
Okay, so you were thinking 3 or 4% decline in the two major cities,
That's
if I
right.
recall. Okay, and you're saying here we are in March, and what you see so far would suggest no, that's not going to
That's
happen.
right. It's
Okay,
actually suggesting, if anything, that housing prices may well rise more than what they did in last year with our two largest cities. And just going back to last year, dwelling prices in Sydney rose by about 9%, and Melbourne, they went up by about 5%. So, yeah, the market's opened up stronger than what we expected, that's for sure.
okay, even Melbourne.
Even Melbourne, look,
Yeah,
not as strong as Sydney once again, but a
yeah.
little bit stronger than what we expected.
Okay, right. Okay, that's very interesting. Now, the other thing we talked about at one stage was distressed sales, and there was some activity in pockets. But I see from your report this morning, it looks like that also hasn't become an issue.
Yes, that's right. So overall distressed listings rose for the month of February, but only marginally so by about 1.1%. We're still about 10.2% down year on year. Now that's at the national level. When we start looking at the individual states, though, we're seeing quite a contrast.
Yeah,
So in New South Wales, distressed listings for the month of February rose by a further 7.3%. So that's a second consecutive increase in distressed activity for New South Wales, and Victoria went up by 3.2%. Both those states are up year on year by 17.5% and 12.9% respectively. The trend of distressed activity is on the rise in our two largest states. It's
yeah.
somewhat offset by a contraction in distressed activity in Queensland and Western Australia. But we're
Okay.
watching the space for our two largest states, keeping in mind that distress activity is still well down on levels recorded pre-COVID. But
Yeah.
I'm a follower of trends, James, and the trend is up for distress activity in New South Wales and Victoria, that's for sure.
So tell me what distressed activity is in the two cities, and what is the number at which you'd regard it as becoming an issue
Yeah,
for
got it.
everybody?
Yeah. So distress activity, by definition, it's property selling where they've been defined in their advertisement as selling under, say, mortgagee in possession, divorcee sale, deceased estates, bank forced sales. We've got about 50 different keywords that we
I
like to
see.
track this data on.
Yeah.
And essentially in New South Wales, the number of listings or properties selling under distressed conditions right now is 1,411 properties. Now, back prior to COVID, that number for New South Wales was tracking at about 2,000 properties. So we're not at those highs yet.
Okay.
In Victoria, the number of distressed listings right now is running at 935 properties. And back prior to COVID, that was running at about 1,200 properties.
Right. Okay. I see. Okay, I get a picture of it. Is it possible, Louis, that could keep going, but it would go, that the market could actually be perfectly strong, could do better than you expected, could do 9% or 8 or 9% this year, and distressed property sales would go up at the same time? They don't necessarily pull the market down with them.
That's exactly right, James. Yeah, absolutely, that's possible, because as a percentage of total listings, these distress levels are still relatively small. So, for example, in Sydney, right, we've got 30,000 listings at present, and the count of distress listings in New South Wales, as mentioned, is 1,411. So as a
Yeah.
percentage, they're still relatively small, and in my opinion, not enough yet to put a dampener on housing prices.
Okay. That's very interesting. You have a fabulous helicopter view there of the market statistically. You devise some of this yourself? Obviously, you're using your own data.
Yeah, absolutely. So
Yeah,
we monitor all real estate listings around the country.
yeah.
And with that, you can put together all types of different charts. The beauty of monitoring real estate listings is it gives you a very timely indicator of the housing market, whether it be stock on market, distress activity, auction clearance rates,
Mm.
asking prices. You get to see what is happening here and now.
Yes, yeah, you really get the tempo of things. Okay, a couple of things I wanted to talk to you about because these are the sort of questions I would have been asking you if we had one of our sort of regular conversations where I come to you as a journalist. About all these building companies that are going under, caught by the fact that there was a spike in inflation and they obviously they basically priced their houses wrong. And they went under, and we get these sort of shocks all over the country every now and again. House builder goes under, terrible for the people involved. I imagine these are buyers in new home markets, but is that an issue, or I know it's a headline issue, but is it really an issue inside the market in terms of its health?
It is certainly an issue with regarding confidence by would-be home buyers and investors to buy new homes and to
Okay,
build new homes, because with the stories of builders becoming bankrupt, that really takes confidence away for someone to go and buy a new home. And with that lack of confidence, you start to see supply of new dwellings start to fall away, and that's clearly showing up in the Australian Bureau of Statistics building approval numbers.
yes, I saw that. They're still very weak, huh?
They're still very weak.
Yeah,
We're on track to build for this year about 150,000 dwellings. The
yep,
long-term average for like the last 15 years has been more like about 190 to 200,000 dwellings a year.
okay,
And to give you some understanding of what we need to build, just to stabilize the rental market, given the very strong population growth, we need to be building a minimum of about 230 to 240,000 dwellings a year. And certainly
right.
that's the number you need to hit if if the federal government's going to reach their target of 1 million dwellings built over the next 5 years. And absolutely, for this coming year, we're going to be well behind that run rate required.
So if they're way behind the run rate, if they're not even building as much as they used to, except in those days we didn't have a 1% vacancy rate, that would just logic would suggest that we're going to have this tight rental market for years.
Yeah, James, we're going to have it for quite some time. The only relief valve I see for the next 12 to 24 months would be some sustained and deep cuts in migration levels. That way,
Yes, right.
you're cutting demand back for new homes. You're relying more on just a natural increase in the population, which runs at about 100,000 people a year. But for us to stabilise the rental market for this year, total population increases would need to come in at about 230 to 240,000 people, given what we know is in the pipeline for dwellings that are going to be completed. So
Yeah.
it's we're not going to get that number, in my opinion. That would mean migration would have to be cut this year back to about 120,000, 130,000 people. I don't see that number being cut back by that much.
Okay. Okay. Very interesting. Hey, one other thing, still on that same sort of patterns in the market. I was looking recently at about how I had expected the regional prices post-COVID, return to work, etc. I had expected regional prices to start to be outpaced by the cities. There has been some evidence that that's not the case. There has been some evidence that the regional prices are actually better in terms of their percentage increase than the cities. Was that just a passing phase? Do you think, looking at what you're
I
telling
think
me
you've touched on one
about
of the
how
most
healthy the big
interesting
city
points in
markets
the
are?
housing market there, James, because
Yeah,
the reality is that earlier this time last year, rental vacancy rates in regional Australia were rising, and we
yeah,
put that down to the return to work from
mm,
people working remotely, where their employers are asking them to come back into the cities and get back into the office. But
Yeah.
what we noticed, starting from I think it was about August last year, regional rental vacancy rates started to tighten once again. So they reversed course and in
Yes.
quick manner as well. And this is right across various regions. And
Yeah.
accordingly, rents started to rise again. And with
Yeah.
that, rental yields went up, and that's encouraged the housing market to move forward in regional Australia as well. So we need to work out why this has happened. Is it the fact that perhaps we've got this major affordability and rental crisis issue in our capital cities, and therefore employees are renegotiating with employers to stay in regional Australia where they can afford? Could that be the part of the
Yes.
reason? Could it also be with the massive expansion in population? Keep in mind that the total population expanded by over 600,000 people last year. Where are all these people living? Can they find a place in the capital cities, or are they more or less being forced the moment they arrive in Australia to live in regional Australia? That could be
Right.
happening too.
It's really interesting. It's challenging some of the assumptions we've always made. The immigrant comes to the city, rents in the middle of the city, perhaps buys a house later on. We sure as hell don't assume they go to the regions. But as you say, it's not the natural explanation would have been that people flow back to the cities post COVID, and those regional towns start to fade, or certainly do not do as well as they're doing, and sure as hell don't do better than the cities. But that's what's
right.
happening. So the explanation isn't clear. So we're into theory.
We're into speculation and theory, and
yeah.
that's the best explanation I've got. Is that there has to have been a new flow of people moving into the regions to create this decline in vacancy rates and a rise in rents and prices. And it may well be directly new visitors to Australia. It also could be the local population, the existing population, being squeezed out of the cities and moving back into the regions as well, or a combination of the both.
Yeah, right. It's impossible to answer, but I still have to ask you, do you think that's a pattern? Because if you're an investor, you're thinking about this, you're saying, the regions, if you got it right, the yields are great anyway. And if you got the price support as well, then it really would be hard to beat as an investor. So do you think it's temporary or structural?
Really hard to know for sure.
Yeah.
I think long term it's good for our national economy to see the growth in regional cities.
Sure, absolutely. Yeah.
And it's something that I've always put forward as one of the solutions to our long-term housing crisis.
Yes.
But the thing is, what I also know, James, is that historically these regional locations tend to be really big boom-bust towns. And as an investor, you do not want to be caught on the wrong side of it. I'll give you an example. A mining town in northwestern Australia, many people know it, called Karratha. Now, back in the last big mining boom of 2002 through to about 2012, median house prices in Karratha went from about $250,000 and clicked over $1 million.
Yeah, right.
Then we had a commodities downturn between about 2013 through to about 2018, and housing prices completely reversed in that town. And they went from north of $1 million back down to $350,000.
And these houses would have not changed, right?
Correct.
It would be a modest bungalow,
as an
probably.
Investor, if you were on the wrong side of that and you took out a mortgage, that's it.
Yeah.
There's your wealth. It's gone.
Yeah. Okay. Yes. But that's mining, Louis. And I suppose that is something that kind of is on a slightly different stream than the work from home and the move to the regions and all that.
No question. I agree with that,
it's a subset. Yeah.
It's a mining town, but we must remember too that each regional township has more sensitivity to the fortunes of their local economy
Right. Yeah.
than,
Yeah.
say, compared to what's going on at the macro level.
Yeah. Very interesting. Okay. That's very interesting, folks. And it's something I think all our listeners should be aware of, that one of the biggest thematic changes in the market, in the residential property market, I think, and I think Louis was more or less agreeing there, is what's going on in the regions. We had assumed certain things. We always assume that the regions don't do as well as the big cities. We always assume the yields are good in the regions. They're good because you don't get the price lifts in the regions. That was challenged during COVID when the regions did quite well and the cities didn't. But what's extraordinary now is we had assumed we would revert to normal. We had assumed that the regional centres would not grow price-wise as well as the cities, but in fact they are. And it's a relatively short term. By that I mean it's monthly rather than an annually pattern. But the pattern is there, and it's a surprise. And people like Louis, who are full-time in this business of property analysis, haven't quite nailed as to why it's happening. And that's fair enough. And they haven't, and obviously it won't come to the party just yet as to whether it's going to keep happening, because we don't know why it happened in the first place. Okay, we'll take a short break and we'll do some questions. Hello, welcome back to the Australians Money Puzzle. I'm James Kirby, Wealth Editor. I'm talking to Louis Christoper of SQM Research. We're going to have a look at some questions now. Some interesting questions. Dusty says, I'm puzzled about negative gearing and investment property. I saw some data over the weekend that in some suburbs in Sydney, 100% property investors are negatively geared. I am puzzled by why property investors are still buying in. Okay, Dusty, two things there. Well, people are buying in because they expect prices to rise. And if the analysts like Louis are right, they may even rise more than we expected this year. I mean, very, very broadly, people are thinking 5, 6, 7% this year. If I'm wrong about that, Louis, tell me. But the second part of your question about negative gearing, I don't know if there's any areas where the people are 100% negatively geared. Have you ever come across that?
No, I haven't, James.
Yeah.
I'd have to question that statistic
Yes.
of 100% negative gearing. I mean, we're talking about investors, for example, that may well have held their property for the last 15 years. Okay,
Yes,
so they're
yeah.
long-term investors. Would they be negatively geared on their property they bought 15 years ago? I would find that highly unlikely.
Right. So the only place you might find that if there was a new apartment complex or something and everybody who went in was an investor. But that's probably unlikely too. Is it because a lot of those new apartment complexes, they would rarely be 100% local investors. You'd have offshore investors who might not be negatively geared. I'm thinking in the cities.
That is absolutely correct. And let's not forget too that new investors in the marketplace don't all necessarily buy with a high loan to value ratio. Some investors put a 50% deposit down. Some even put down a 60 to 70% deposit down. And as you point out, some buy with cash. So perhaps for those that are buying right now with a high loan to value ratio of say 90% plus, they would initially very likely be sitting on negative gearing.
Yeah. Yes, yeah. Okay, good point. All right. Okay, so there you are, Dusty. The negative gearing is used, of course, because it exists. Politically, it's under threat. It's always under threat, but it's really a question of how real the threat is. It's very hard to know just now. I mean, it's literally a week-to-week speculation. If CGT seems to be in the gun this week, but it could be negative gearing next week. The Prime Minister denies all the time that he will go near either of those, but then we can't really take that seriously anymore since he has changed his tune on tax cuts, personal tax cuts, and that does mean that he could do that again. But we'll leave that there for the moment. Thank you for the question, Dusty. Amy, AMEE. Is it true that if one-bedroom units are hard to sell afterwards, it's all I will ever be able to afford in this market? One-bedroom units, if I was starting especially in the cities, and I wanted to get into property, it would be obvious to me that my first chance would be a one-bedroom unit because it would be the cheapest option invariably in the market. Has the story on that changed, Louis? Like, are they more or less attractive as investments than they used to be?
There is, James, there is no evidence that over the long term, units, neither two bedrooms or one bedroom units, underperform the greater market. And when I say that, I'm talking about established units.
Okay.
Now, what we often find is that new off the plan units will
Mm.
underperform the market for the first 5 years. And they
Right.
tend to do that because they're depreciating in value. All those new fixtures and fittings are literally depreciating away. Okay. But in the long term, uh, when you take into account total returns, and when I say total returns, that is rent plus capital growth, we find that units perform in a similar way that houses do.
Okay.
Okay, so I don't believe there's a lot of evidence to suggest that units continually underperform. One of the things we have found, though, is that in rising markets, houses tend to outperform units, and in
Yeah.
falling markets, units tend to outperform houses. So
Okay.
units have tended to be more of a defensive play. That's certainly been the case for the last three cycles now.
Okay. And what
One
about one
caveat with
bedroom?
this
Sorry.
sorry, Gaines. One caveat with this is that, of course, in this country, we've had a long-term undersupply of property. Should
Mm.
there come a time when we go into oversupply, that oversupply most likely will be on the unit side, and that would be the
Yeah.
time when you would perhaps see units underperform houses through all parts of the cycle.
And we have seen that. I remember distinctly Brisbane at one stage where there was an oversupply of units,
Absolutely.
and particularly of units, and it really did hit for a while. But just Louis, back on that. So there's no particular disadvantage of one bedroom units over others,
No,
two
there's
bedrooms or
not.
three
I
bedrooms.
mean, here we are. We've got a person here who's looking at a one bedroom unit because that's what they can afford.
Mm.
Well, guess what? That's what a lot of the population can afford,
Yeah. Yeah.
and especially younger people in terms of getting into the market. Will they be restricted to only holding a one bedroom unit for the rest of their lives? May I say that's very unlikely. As you
Okay.
find, as you develop in life and you get a little bit older and more mature and more experienced in your career, you'll earn more than the national average wage increases. It just happens because employers value your experience more and more as time goes on, and your
Mm.
real wage rises disproportionately to the national average wage. And
Mm.
therefore, that gives you the ability to increase or scale up your purchase. Over and above that, you're paying that unit down. You're building capital in that unit,
Yeah.
okay,
Yeah.
as you're paying that mortgage off. And that
Yeah.
is genuine equity which can be applied to your next property.
Terrific. I suppose putting it simply, you're in the market. You're in. It's a
You're
one
in,
bedroom
and,
unit,
and
but
you're a
you're
lot
in.
better off compared to those who are
Yeah.
not in.
Yeah, exactly. Okay, very good. All right, we'll take a short break and we'll be back with one last question from Richard. Hello, welcome back to the Australians Money Puzzle podcast. I'm James Kirby, Wealth Editor at The Australian, talking to Louis Christoper of the SQM Research, Property Research Agency. As I say, a very well-known voice in the market and a very independent voice. Always terrific to talk to. Now, Richard says, and I'll just read the full piece here. We purchased a second property during COVID on the Sunshine Coast, which we intend to live in when we retire. We have been short-term letting. It's so that we can use it ourselves when we want to. So this is Richard, very not unusual, playing both sides, if you know what I mean, of property, with views to both making investment income from both the properties and also using both the properties. Now, here's the rub. Recently, we got a letter from the council stating that due to an integrity check, they had decided to double our rates as we were short-term letting the property, and they need to address the housing shortage. Perhaps you could explain how doubling our rates will address the shortage of housing. Yeah.
Well, that's a very good question. Look, that
An
surrounding
integrity check. Did you ever
yeah,
hear of
that's
that?
right. Look, I'm a believer in more liberal markets, and I don't believe increasing taxes encourages supply. We
Mm.
still live in a liberal market democracy. where the economy, market forces determine prices.
Can I just jump in and ask you then, do you think that part of the Melbourne weakness of late was due to the land taxes that were rolled in last year?
Potentially, yes.
Okay.
Yes.
Yeah. Right.
But I think there's other factors at play, and there usually is in the housing market. It's always hard to point out just one factor.
Okay.
So there's a lot of, just on this point about letting and taxes, there is, of course, more and more discussion, particularly surrounding local council, about taxing Airbnb properties or short stay listings.
Oh, yes, that's in Victoria as well. Yeah.
And, that's an interesting debate too. So there's no question, we've seen in our data where there's been this movement away of properties from the long-term leasing market into the short-term leasing market. And I put that down to a couple of factors. One, I think landlords feel they have greater control and a greater say over their properties. Two, landlords get more rent out of short-term leasing. Three,
Yes.
there's a lot more demand, a lot more structural increases in demand for short-term leasing as well in this country. And that has resulted in the fall in long-term leasing properties in Australia.
Right.
So it's created multiple issues. In short, I do not believe taxing landlords excessively is going to resolve our housing rental crisis. If anything, it'll be rather counterproductive.
Okay. And specifically, councils actually doubling rates is interesting for an integrity check. Never heard of that one. Doesn't name the council. Richard doesn't name the council or where it is. But it is an interesting issue. And negotiating the taxes are part of being a property investor. I think we could all agree on that. Just a question of how successfully you do so. And there are different taxes in different states, and there's an element of arbitrage available to any investor looking at the different states and how they behave. But they are always thinking of ways they can tax you. But Victoria and Queensland sort of been outstanding in recent times on that front. All right, terrific. Hey, thank you very much, Louis Christoper of SQM. It's great to have you on.
Nice to be with you once again, James, and hopefully your audience has found it useful.
I'm sure they have. Thank you very much. And we'll talk to you again. Okay, thank you, everybody. That was Louis Christoper. Remember, I'd love to have some more questions, comments, observations, especially on residential property and where it's going and what you think is happening in the market. The Money Puzzle at theaustralian.com.au. Very good. Talk to you soon.